So welcome back. Today is the Monday, 6th October. So we are going to be looking at what went through the New York session. We are going to be going through the pre-session from 7 to 9:30. Then we shall look at what went through after the opening bell, going into 10 a.m. You might excuse me, I'm having a problem with my voice, but with 7 a.m., you know the drill. We have to have the 12 a.m. to 12:30 opening range on our chart. So it is denoted right there, the yellow box. It's 12 a.m. to 12:30 opening range. I want to pull your eyes to the draws on liquidity for 7 a.m. So 7 a.m. opens up with drop, going for these lows. So 7 a.m. prints for you a model that will give you insight about what will happen in the day, going through the day. So first and foremost, we first take out sell side, minus sell side. Right here we have these lows. We take out these lows as minus sell side. If I can denote this as my minus sell side, right there, making this red. This as minor sell side, liquidity. So we take out minus sell side, then we'll rally higher for buy side. But as you can see, 7 a.m. opens up. We have this fair value gap from this candle's low to this candle's high, right there. They're missing. So we have this bearish fair value gap. We have a low, so we have a low, a high. So this is something of this sort right there on the lower time frame. So I'm looking for something like this to get the low of my breaker to the high. So I have this candle starting from here, we go up, then this candle's wick right there, this is a low, then a higher high. So from this candle's open to this high, that's where I'm taking my fib for the optimal trade entry. You know what I'm looking for, the inversion, if you have been with me. So I'm looking for that, just that. Okay, excuse me, this candles low. So what happens here, will rally above these levels. I didn't expect the market to come back into this optimal trade entry of mine, just because I didn't have a candle that went above these levels. So we had wicks manipulating, then we dropped lower, so I didn't have candle closures, but we dropped lower, forming a fair value gap going into 7. This is my fair value gap slow right there, going into 7. So this is a bearish fair value gap, forms one candle, second candle, third candle. We tap that, we stay in the lower quarter, we move higher, fill this, and then we reject. The market gives you another entry one more time, you add to that, then we drop lower for minus sell side. Now that is for scalpers. Minus sell side, you have these lows. How far can the market go beyond these lows? We have how far can the market go beyond these lows? We have this negative 0.25 and it gets hit. But I'm not looking for this move because these draws on liquidity are before 7, and I'm looking for something to get inside after 7. So I'm having this candles high, the candle that formed the fair value gap, and this high that fills the fair value gap. This gives me sell side, buy side right there, buy side. So I'm having buy side liquidity for my session. This is my first target, this candle's high right there. Having this as blue, this is my buy side liquidity for short term. This is buy side liquidity. Okay. So after this buy side, before this buy side, we have a move that drops lower. We have a fair value gap right here. Now this is the ICT gauntlet. You have this fair value gap, this bearish fair value gap. After taking out significant sell side, we drop lower. Now the market comes back into this. The moment the market comes back into this, we have taken out minus sell side, we drop lower, failing to take out this low. This is an indicator that the market is going to go higher. The moment we come back into that, this is your execution, this candle, we close back into this fair value gap. That is your execution for buys. So this has already given you a signature in price that this fair value gap is going to be inversed. Now many of you be asking, how do you know that a fair value gap is going to turn into an inversion fair value gap? Just like that, just like I just mentioned. So these are the things you screenshot and you keep in your record. So we have, if you waited for a fair value gap to be inversed and a retest, you wouldn't get in. This is the ICT gauntlet. You enter right there. If I'm to, let me mark this. This is the ICT gauntlet. Isn't this nice? Having studied. Yeah, so this is I think it owed this in the 2025, it's 25 cents, I don't know, yeah, 2025. So this is ICT gauntlet. The moment the market comes back into this, we drop lower, we come back and close into that. Your execution for buys right there, stop loss at this low, you will not get stopped out. You're having this as your buy side, first partial, second partial, taking you into price action. Before we have this high right there. So I'm looking at that high. If I'm to mark this as my buy side for this session, how far can the market go above that high? From the move that started the rally into that high, because this was, if you can see, this was still accumulation. The market was still deciding on whether we are going to take out this high. So we have this candle's low to the high. What do you have? If I'm to mark this low for you, just like that, I'm going to zoom in. I'm going to zoom in one more time. Note that blue line above the negative 0.25. In this session, have the ICT gauntlet. We fail to come back into this fair value gap. We have a volume imbalance right there. The market rallies. This bearish fair value gap rejects the market coming back down into that. The market rallies. This is accumulation of orders, or the market making fuel for this move that's going to take out this high. The market rallies, closes above. This becomes an inversion. This is an inversion fair value gap, just like that. We drop lower, coming back into this order block. See? This This is a bullish order block right there. Bullish order block will drop lower after closing into this. Now if you entered at this candle, this is entry 1, layering positions, entry 2 or entry 2 after this candle's closure, you enter the second trade after the inversion of this entry 3 will rally higher with speed, no retracements. Just go back again, we drop lower into this inversion, this volume imbalance, will rally higher with speed, taking out this high for 7 a.m. telling you to look at that. We'll go into this high. It's not a significant high because this is not the actual draw on liquidity. This line is the actual draw on liquidity. You see, we'll rally higher. The moment we close above this, we do not have a retracement. If you want to see that the high was the main draw on liquidity, after it is taken out, the market tends to reverse from that high. So this high was taken out going into 8 a.m. We formed a fair value gap before that. As you can see, this is a bullish fair value gap right there. Have a bullish fair value gap. Bodies remain below. If I'm to zoom into this, bodies remain in that fair value gap. Bodies remain. We rally above, retrace back into this candles wick right there. So if I'm to mark quadrants on that, if I'm to draw quadrants on that, zooming into this week, we fail to hit consequent encroachment of that week. We fail, showing what? Showing bullishness. Isn't that beautiful? Showing bullishness. We drop lower into that, fail to reach consequent encroachment. We just push higher into that, taking out this high. This move for 8 a.m. started a rally, a one-sided rally. You see the fair value gaps are left open. This is the breakaway gap, breaking away from this range. We break away, run into this high. This is the high on the 1 minute time frame. How far can the market go above this high? Negative 0.25. We rally above that, we have a retracement into this fair value gap. So you mark that. We have a volume imbalance right there. Yeah, we do not have a volume imbalance below. So I have a volume imbalance right there. That is a bullish fair value gap. Note that bodies are respecting the consequent encroachment of that. The wicks are doing the damage. So we rally into negative 0.25. If I can take this off, and that is done with. So 8 a.m. we rally into the negative 0.25. We drop lower. We have a fair value gap right there. Market fails to inverse that, pushes back into what? The fair value gap that led to the takeout of the negative 0.25 is what you use as your first inversion, your first entry. If I'm to mark that as the inversion fair value gap, this is the most reliable inversion fair value gap. In an inversion fair value gap that forms before we rally above liquidity or before we go to your target. If it is inversed, it is the most reliable fair value gap. So we drop lower, inversing that. We come to this one, we fail to close. This holds the market. We drop lower, inversing this. Okay. So you would want to have everything you denoted extended in price. So okay, so we drop, we give you a fair value gap right there, we retest into that, we fail to reach into this, we continue lower, coming back into what? That fair value gap. You want to have everything you had extended in price. You understand? So you're going to use this as reference to your future trading. So okay, so my eyes are on that. We drop lower going into, so we drop, accumulate, going into 930. Remember, a new day is opening up, we have accumulation, we manipulate. So the whole of this range, this is accumulation of orders. So the market is inducing traders into taking the wrong bias by buying prior to the opening bell, as you can see. So I'm having this as accumulation. Let me mark this as green. We have this as accumulation, we manipulate higher. This as my manipulation from there, this whole move. This is my manipulation, that manipulation. So now I'm hoping for what? Distribution. And distribution is what? Standard deviations of what? The Judas swing. So if I'm to measure my Judas swing from, let me see, look at this, -1 fib level. This is 1 standard deviation. Market continues lower. How far can the market go if it surpasses the -1 standard deviation? The 1 standard deviation, the 1.5, we drop into that 1.5, then we continue higher. So I'm looking into this, and I'm having the 12 AM to 12:30 opening range just below that. We take that off. So that is how far I'm measuring. And let me first bring that back. I told you in my recent videos that if what level is so applicable for the market to reach for is half of the range between the 1 standard deviation and the 1.5. So if I'm to measure this, half of the range, draw quadrants on that. If I extend this into price, I'm having half of this range aligning with sell side. You understand? Aligning with sell side. Okay. So we have our accumulation. We come back. We have our accumulation going into 930. So 930, I'm looking for my opening range. My opening range is down. I'm looking for sells. I'm not looking for any buys right here until we come to this opening range. So I'm looking for sells. 930, we have accumulation. We manipulate. I'm having this that can be turned into a breaker. So put this off. This can be turned into a breaker, this candle's low. And what do I look for if I see a move like that? My optimal trade entry. So I'm having just like that of that range, optimal trade entry marked. This is the 930, and these are equal lows that were formed after 7. So after 7, I'm having this as my sell side. You don't even need to look at the price action before 7 AM. You're looking at these lows formed in the pre-session, relatively equal lows formed, and there is a high percentage that they will always be there. The lows, equal lows or equal highs formed in the pre-market session. So I'm having those lows marked, and this is my draw on liquidity, first draw on liquidity, and I'm having 12 AM opening range. So what happens? we have a move above that, we drop lower, close, come back to the sweet spot. This is my best entry right there. Stop loss at 1 standard deviation and a drop lower into sell side. So here you have a one-way run to take profit. This, so this is my first entry. This the moment it touches the 0.618, that's my entry. We rally higher into the 0.705, second entry, we drop lower. So the wick that we tested into these levels is an order block. So I'm having this candles wick right there. Most of the times the market will retest into that wick, the wick that we tested into these levels. So this candles wick will retest into that entry number 4, will drop lower. The targets for the fib are taken out. So this is an order block. This is a bearish order block. Believe me or not, it is an order block, and there is no way you're going to get it apart from this channel, trust me, because ICT didn't teach this. So we have this candles wick as the order block, we drop lower, we come back into that. So these wicks go on becoming order blocks. And using what ICT taught, I'm having a fair value gap right here. This is the first presented fair value gap. You need to have this in your trading of the opening bell. So I'm having first presentation fair value gap. For first presentation fair value gap, it's a fair value gap that is formed after 931. So I'm not looking at the 930 candle, I'm looking for the 931 candle. If the 930 candle is with the candle that forms the fair value gap, I'm not considering that fair value gap. I'm waiting for a fair value gap to form after 931. So 931, we drop lower, 932, 933, we form a fair value gap. This is my first presentation fair value gap, and as you can see, it holds the market well. And how far above this first presentation fair value gap can we go? I'm having, this is a balanced price range. This candle dropped lower, it went back up, this opened, went back up. So from this candle's high to this candle's low, just like that, that is a balanced price range. So I do not expect the market to surpass that. Now that's why ICT tells you that you need to take your stop loss to the low or high of the second candle, because that is a balanced price range. The candle drops, we work into that, go back higher, this works into that, we drop lower. So every business around here has been filled, and as you can see, the market goes into it. The bodies respect the first presentation fair value gap, but the wicks do the damage until what measure the 0.5 of that range. So this is a balanced price range, as you can see. We drop lower, coming into these lows that formed at after 7 a.m. we drop lower into that, we manipulate. How far below these lows can the market go? So these things keep on repeating themselves. How far below those lows can the market go? Supported high and low. This. I want to get this to the tick. Okay, so we have the market dropping. How far can the market go below that? Oh, sorry. So we have this drop lower, then the move that decides the take of these lows is this. Starts from this. That's the move that starts the run to those lows. I do this fib wrongly, I'm sorry. So from that, yeah, that is it. Come to draw this. How far can the market go below this low? the negative 0.25, just like that. And I need a screenshot of this. The screenshot of that. We drop into the negative 0.25 smoothly, and after that going into, so this is 10 a.m. opening up. 10 a.m. opens up. This is just jagged price action preparing for what? For longs. Now most of the traders were stopped out within this range. First presentation, market was working in the first presentation, then dropped lower. So this is all time distortion after 10 a.m. open up, drop, take out buy side, showing you unneeded that the market is now looking for buy side and not sell side. We take out buy side, then we drop for sell side below. This starts a move after we reach this. This market does not rally for higher prices until we reach the negative 0.25. We reach that, we start rallying higher, going back. Now we are working in this order block that I talked about. So yeah, I think that's what went down for today. Thank you guys. Please subscribe and like. Thank you.